Good morning, everyone. This is Professor CA Amit Bhatia, and today we are going to start with continuing our hedging strategies like we had done earlier. There are different techniques of hedging which we had discussed last time around. So we had discussed there were internal techniques and external techniques. We discussed these internal techniques and then we had started with money market hedge. We had also done a sum on that when we calculated how to go about constructing a money market hedge and then comparing that with the forward contract to determine which one is a better option. Now, today we are going to introduce on the derivative instruments. When I say derivative instruments, I'm not really going to venture into derivatives per se, because that you will learn in your derivative module. What we are going to learn predominantly is currency futures, currency options, and currency swaps, right? So limiting it only to the forex part. That too, especially as we will be calculating and determining whether these are good hedging techniques, and then we need to compare and inform our client which is a better decision to go for money market hedge, to go for currency future option, or the swap. All right. Now, before we start with that, the last time we left, we had done one sum on leading and lagging. So I'll start with a couple of concepts to take it forward ahead with leading and lagging. We'll solve with one sum on leading and lagging, and then we will continue with futures and options. Right? So the first concept that we are going to start today is about swap points. Right? It is about swap points. Which are also known as forward points. Now, what do you mean by swap points or forward points? So, say for example, if my dollar to rupee quotes are given like this, that is bid, and ask is given to us as 48.40 and 49.20, right? This is my spot rate. And then I have my future rate, which is given to me by the bank. So that is given to me as, say for example, it says 49.60 and 50.80. So what is swap point? The swap point is nothing but the difference between your spot rate and future rate. So here you can clearly see 48.40 is my spot rate, and say for example my 3-month future rate is 49.60. That means in 3 months time I am expecting that the price will improve by 1.20 rupee per dollar, right? Sorry, dollar per rupee. And let me change the currency over here slightly. Let us make it as rupee per dollar. Rupee per dollar. Right? So it essentially means that there is a change of 1.20 rupees. That means rupee vis-a-vis dollar is going to appreciate or depreciate. Yes, can anybody help me out on that? Is the rupee expected to appreciate or depreciate? Now you can see dollar is currently priced at 48.50. This is a direct quote, remember? So when dollar is going to become more expensive, right? Which means rupee is going to depreciate and dollar is appreciating, right? So dollar over here is appreciating. You have already learned what is the concept of appreciation and depreciation of a domestic currency and foreign currency, right? In the very first session. Now, here, what we are identifying is what is the meaning of swap points or forward points. So these differences are known as swap points or forward points, right? Let us take another example. Say if the rate is It's GBP to dollar, 1.20 and 1.30. And let's say the 3-month forward rate is 1.28 and 1.40. Okay. So here, what is the swap points or forward points? It is 8 points, right? Which is nothing but 0.08. Yes, it is 0.08 shillings, right? Because GBP is in the numerator. Remember, the base currency is dollar. And here you get 0.10, right? Now, sometimes swap points or forward points are given to you not as directly as points. So, for example, you are given it is 25 by 30. Sometimes they give you as 25, 30. Then you know for a fact this 25 is basically to be added into the spot rate, right? So you directly add into the spot rate to get the forward rate. So if my spot rate is 48.40 and I'm told swap points are 25 is to 30 like this, then that means forward rate will be 48.40 plus 25, 48.65. Now always remember, swap points are always to be considered in the decimals, right? So those are always after the decimals, never before the decimals. So say for example, if your number is given to you as 4-digit currency, let's say I say it is 48.4014, then in that case this 24 will be added into 14. This 25 and 14, so it will become 48.6039 in that case. Sorry, 4039 in that case, right? Similarly, if you have 49.2025, for example, then this 30 points will be added into the decimals over here, which will become 49.2055. So you need to remember that swap points are always added in the decimal part of it, right? So you imagine these are basically just numbers, for example, right? So if it is 4014, just imagine that is 4014 and you need to add 25 to that. So it will become 4039, right? Into your forward rate. Same goes with in the ask rate as well. You will take again your spot rate 2025, add 30 into it, it becomes 2055. Now this is the normal practice, right? Because bid price is also given like this only, bid and ask. So it will be given like 48.5 and 49. So this is generally how your bid and ask price is represented or expressed. However, there is also practice, very common practice, wherein your swap points are expressed not with this hyphen, but rather as a numerator upon denominator. That is 25 upon 30. So in that case, how do I come to know whether this is a premium or a discount, whether the forward rate will be premium or discount? Because when the bid and ask price or the bid and ask swap points are given to you 25, 30, and you know there is no negative sign here, then you know it is appreciation, so the price will increase. If there is a depreciation, then it will come in negative, right? So you know for a fact that you need to subtract this 25 points over here. However, when you are talking about numerator upon denominator, that does not become clear enough as to it is a premium or discount. Then how will we identify this? I repeat, swap points sometimes are expressed as numerator upon denominator. You can see over here, right? Then how do I identify whether it is to be added or subtracted? Remember, if it is premium, then we add. If it is discount, then we subtract from the spot rate, right? So, say for example, here I am taking one example, rupee per dollar, right? I have, let's say, 78.1345 and 79.1022. So this is my bid price, right? And this is my ask price. Now you are told swap points are 25 hyphen slash 30, that is given to you as 25 upon 30. Now whenever swap points are expressed like this, remember again this is swap point, so I need to add over here or subtract over here, but I do not know whether this is premium or discount. So how do I know this is premium? So please note over here, whenever swap points numerator, your numerator, so numerator is lower than your denominator, right? When your numerator is lower than your denominator, it means forward rate is positive, meaning it is a premium, right? So we say 78.1345 plus 25, so it will become 1370. This is the way to read this particular information, right? Similarly, in ask, it will become 79 point, these 30 points has to be added over here. It will become 1052. Now, what happens if this swap points had been the other way around? Say, for example, in the same example, okay, if the swap points had been written as swap points, let's say, had been written as 30 upon 25. This is a separate example, right? And this is another example. So then in that case, how do you interpret it? Remember, here it is the other way around, right? Numerator is higher than denominator. Numerator is higher than denominator. That means this is a case of discount, right? This is a case of discount. So you need to subtract this. So this will become as 78. Forward rate over here will be, what will be the forward rate? 78.1370 minus 30 points, right? So it will become 1340. And here it will be 79 point, let's say 1052 minus 25. So it will become 1027. Right? Are you all getting the concept?
Yes, sir.
Yes. Okay. All right. Now, using this concept, we are going to take one question on leading and lagging using this same concept, and then we practice that, right? I believe you have the assignment 2, which was shared with you, right? So yesterday that has been shared with all of you. You may please look at that particular question. Let me take that question over here as well. Question number 7. Question number 7. Number 7. This is our question number 7 from assignment sheet 2, which was shared with all of you yesterday. If you don't have it already right now, you can take it later on. Right now, you can look at it on the screen. Gibraltar Limited has imported 5,000 bottles of shampoo at landed cost in Mumbai of $20 each. The company has the choice for paying for the goods immediately or in 3 months' time. It has a clean overdraft limit where 14% per annum rate of interest is charged. Calculate which of the following method would be cheaper to Gibraltar Limited. First, pay in 3 months' time with interest at 10% per annum and cover risk forward for 3 months. Second option is settle now at a current spot rate and pay interest of the overdraft for 3 months. The rates are as follows. Mumbai rupee to dollar spot rate is given to you as 60.25 to 60.55.
Amitji,
Yes, sir.
is there any message that the assignment is not available?
I'm sorry.
Sir, is there any message that someone has student has put in the chat that assignment is not available, something like that? ऐसा किसी ने कहा तो नहीं है?
Assignment 2 has already been shared, right, sir?
हाँ sir, it is already been shared. It is on website. It is on SSB portal.
So that is what I just now mentioned.
Okay, student, please continue.
Yes. Just 1 minute. Let me have a check in if somebody has. As mentioned to all of you, assignment has already been shared yesterday itself, right? So you can check it from there. And right now, without actually, further ado, we can essentially focus right now on what is there on screen. Okay. You can even download that particular sheet in some time. Okay. So please focus on the question which is there on the screen. All right. So here, your rates are as follows. You are given Mumbai rupee to dollar spot as 60.25 to 60.55, and 3 month swap points is given to you as 35/25. Now tell me, this particular 3 month swap points, is it premium or discount?
Discount.
Premium or discount?
Discount.
Discount. Why is it at discount?
So
Points are given like first point is higher and the second one is lower.
Exactly. It is numerator upon denominator, and wherever you have the first point higher than the second, then in that case, it essentially means that it is a discount and not premium. Had it been the other way around, 25/35, then it would have been premium, right? All right. So now here, let's do the comparison. So how do I go about it? What is my option 1? Pay in 3 months' time with interest at 10% per annum and cover risk forward for 3 months. If I'm going to cover risk forward for 3 months, it essentially means I will need to book it at the forward rate, right? So I'm essentially entering into a forward contract. So let's start. First of all, we will start evaluating the two options. Remember, he has imported 5,000 bottles, so he's an importer, so he has an obligation to pay, right? He is required to pay. How much is he required to pay? What is the amount involved? Yes. How much is the amount involved? It is $20
$1 lakh
into 5,000. Am I right? So that becomes 1 lakh.
dollar.
Yes, $1 lakh. So what Gibraltar Limited essentially is required to pay is 1 lakh US dollar. Now, if he has to make a repayment in 3 months' time, then how much money would he have to pay? He would have to pay this 100,000 multiplied by, you also need to pay interest, right? What is the interest rate over here in the first option?
10% per annum for
10%
3
per
months
annum.
only.
And you have how much period? 3 months, right? So it is going to be 1 plus 10% divided by, yes, 1% divided by 4. Can I say so?
Yes, sir.
Right? In other words, this is 10% into 3 divided by 12, right? So my amount in that case turns out to 100,000 into 1 plus 10% divided by 4. So I believe that becomes 102,500. This is what I would have to pay with interest in my first option. So I need to take a forward cover for the same, right? Now forward cover will be taken at what rates? Yes, what are my forward rates? Rate, and then I'm told 3 months swap points. Okay, all right. So I'm told my spot rate is 60.25 and 60.55, and my swap points, 3 month swap points are 35 and 25. So what will be my forward rate? 3 months forward rate. 3 months forward rate. This is 35.25. So this is premium or discount? Discount, right?
Discount.
Because numerator is higher than your denominator. If you want, I'll write over here again. Numerator is higher than denominator. Right? All right. Now, in 3 months forward rate, I'm going to say it is 60.25 minus 0.35. Am I right? So I get 59.90. 59.90. And similarly here it will be 60.55 minus 0.25. So it becomes 60.30. All right. Now remember, these are the bid and ask rates. Bid rate is the rate at which you sell. 60.30 is the rate at which you buy. Am I right? Here,
Yes, sir.
I have an importer. Importer is in need of money. So what is going to be my repayment obligation 3 months down the line? After 3 months, I would need how much money? I would need 102,500. I would need 102,500 multiplied by
60.30.
60.30. Very good.
61 lakhs 80,750.
Okay, minute. So it comes to 61 lakh 80,750 rupees. This is option 1. Right? Now I need to compute for option 2. Okay. What is my option 2? Settle now at current spot rate and pay interest of the overdraft for 3 months. So first of all, if I am going to settle now at current spot rate, so what is my current spot rate?
60.55.
I will need to buy at spot rate, right? So I will buy at 60.55 and then pay interest on it for 3 months at what rate? At overdraft rate of 14%.
14% for 3 months.
Okay, 14% for 3 months. So if I am going to go for overdraft, I will need how much money? Overdraft option, right? So I'm going to have USD 100,000. 100,000. So in rupee terms, that will come to how much?
62 lakh 6,375
100,000 into
multiplied by 60.55.
Am I right?
Yes, sir.
So this will be at right over here at 60.55. All right. So this is my overdraft value. Now I need to pay interest on it. So let us add the interest on overdraft. So overdraft was at what percentage?
14%.
14% per annum. Now remember, interest is always per annum. In case of futures over here, we always have interest which is per annum. Okay. So we need to be careful that it is a 3-month period. So my interest is going to be 60,55,000 into how much? 14% divided by 4. Am I right? So it comes to 211,925, everyone. Is it coming to
Yes, sir.
211,925? So my total amount now becomes how much? Total amount which I am required to pay. Total amount paid will be how much? 62, 66, 925. And in case of the first option, that was 61, 80, 750. So which one should we opt for?
Option 1.
Yes. So in that case, option 1 should be preferred as it will save. You can write the amount if you want. Save rupees how much? You can write over here, it will save rupees 62, 66 minus
86,175.
86,175. Right? So here, this was a question on leading and lagging as such, question number 7. And here we learned how to apply the concept of swap points when they are given in numerator upon denominator format. So when the numerator is higher than denominator, it is discount. When numerator is lower than denominator, it is premium. If it is premium, we add to spot, and forward rate will be spot plus swap point, you will get forward rate, right? If there is a discount, then spot rate minus swap points, you will get the forward rate, right? Okay. Now we start with the first concept which we had discussed on the derivatives part, right? So in the external techniques of hedging, the first one was money market hedge, right? Now in the derivatives, you have 3 options on the currency part. Which are those 3 options? We have futures, we have options, and then we have swaps, right? So we have over here futures, options, and swaps. Swaps we will take it slightly later. So first of all, we start with the first concept of futures and options, right? Now, what do you mean by futures? Any idea? Anybody has any idea? Because here it is often students get confused between forwards and futures.
Under forward, we can have a delivery, but in futures, we can have an option to settle instead of delivery.
Very good, very good. So here there is delivery of actual underlying asset involved. In case of futures, basically what you are doing is you are trying to deal in differentials, right? So you settle the position by way of taking an opposite position, and that's how you close the position, and the differences will be settled by paying out the amount. So very simple example is the futures which you do in, let's say, in your stock exchange, for example. Let's say I am saying today that I have, let's say, RIL shares, right? On RIL shares, I'm taking a certain position. I'm, let's say, taking a futures position on, let's say, 5,000 shares. Okay, I'm buying a position on 5,000 shares that 3 months down the line, I expect the price to appreciate. So I'm taking a position on this. Which position should I take? Should I be taking a buy position or a sell position right now?
Buy position.
I will buy the futures, right? So if today, let's say, the rate is available in the market is, let's say, 2,200, and I am expecting that 3 months down the line, it will be 2,300. So I'm expecting that there will be a price increase of 100 rupees. So now, without actually having to invest 2,200 into 5,000 rupees, the total amount, what I have done is I have essentially entered into a futures, right? Wherein 3 months down the line, we will have essentially a position, we will take care of whatever is the position, and whatever is the difference will have to be settled between me and the other party, right? Now, remember, there are certain aspects. Futures contract generally are standardized, right? And their quantity is already predetermined. So it always is in a predetermined standardized quantity that you can essentially place your futures. Like in case of forwards, I have a need of, say, for example, $455,000. Okay, so if I want to enter into a contract of $455,000, I can do that. But say, for example, if it is future and the futures are defined as contract in multiple of, let's say, $10,000, then I will have to take essentially how many contracts over here? I will take 455
0.5.
divided by 10,000, right? Which means I'm going to take how many contracts? I will need 45.5. But fractional contract is not available to you. So you will have to essentially settle with
45.
position
Or
for 450,000. The balance 5,000. Either you can cover it through forward cover, or you may just decide to take that much risk if you want to, right? So, or of course, if you want, you can even take 460,000. You can take the entire next position altogether that I want to have 10,000 more. But then in that case, you won't have the remaining 5,000 to essentially fulfill that particular contract, right? So that will be a slight challenge for you. But otherwise, we generally, whenever we are solving sums, we will always take a position of the whole numbers over here. The fraction will be ignored unless otherwise specifically mentioned in the question that you need to take the rounded off to the next number, right? Okay. So here in futures, say for example, I am an importer who has an obligation to pay. This was about shares. Let's come back to currency. Okay. Okay. So in futures contract, let's say I am an importer. I am an importer. Okay. And I have an obligation to pay after 3 months. So after 3 months, I will need, let's say, $50,000. Yes. So now the question that arises is, as an importer, I need $50,000 3 months down the line. Okay. So should I be buying futures contract or should I be selling futures contract?
So price expectation पे depend करेगा and rates.
Okay. So what do you suggest? Should I take the position as, should I sell the currency or should I be buying the currency? 3 months down the line, what is your requirement as an importer?
I have to purchase that dollar.
I will have to purchase the dollar, right, to settle my claim because I have an obligation to pay. So for honoring that obligation, I will need $50,000 at the end of the 3 months, right? Am I right? Hello?
Yes, sir.
Right? So I will essentially take a buy position, right, for a dollar contract, futures contract. On the other hand, if I am an exporter, for example, on the other hand, if I am an exporter, right, who has to receive after 3 months, I am going to receive, say, for example, $100,000. So in that case, are you going to buy future dollar contract or sell future dollar contract?
Sell.
You are going to sell, right? You will need to sell because I am going to receive dollar, right? So I am going to essentially sell. Now there is also a situation which arises wherein sometimes you are essentially looking at a futures contract which is about dollars, but it is priced in rupee terms. Then what will you do? I repeat my question. I want to buy US dollar, right? However, the contract is expressed not in dollar terms, but it is expressed in rupee. Then what do I do? Should I take a buy contract or should I take a sell contract?
Sir, in case of importer, I will sell a rupee, and in case of exporter, I will buy rupee.
Yes, you will need to essentially, because if say for example, the underlying currency it is valued, underlying currency may be dollars, but it is, let's say, priced in INR, right? Priced in rupees. Then I will need to essentially take a reverse position. Why? Because I am going to sell rupee. Am I right? And buy dollar. So here, in this particular case, if my contract is essentially expressed in rupees, then I will say I am going to take a sell contract. The reason being, I am essentially buying dollars. That means indirectly I am selling rupees, right? So I need to, in that case, have a sell contract. Similarly, for exporter wants to sell dollars, or in other words, you can say he wants to buy rupee. So you need to be clear as to what is the pricing of that particular contract. Contract is essentially expressed in rupees, in dollars, or which currency it is, right? And which currency do you want to have? So just understand the mechanism, whether you want to receive dollars or you want to pay dollars. And then it is very easy, because if I am going to pay dollars, that means I am going to essentially receive rupees, right? Then I might say essentially that I am buying rupees. Okay? Clear to everyone? All right. Now, generally, we use the term over here, instead of buy, we call it as long and short, right? Okay. Now, let's take one example. Before we do the example, let me introduce the concept of options also alongside, so that it will be easier for us, right? Okay. Let me introduce the concept of options also, so that then we can go on to the practical questions. All right. Now, options. Now, what do you mean by options, first of all? Option basically is giving you an option whether you want to buy or sell a particular underlying currency. Now remember, our underlying asset always is going to be currency, because we are learning Forex, right? So our underlying asset is always currency. Options can be there in any other commodities, stocks, or any other thing as well, right? As long as both the parties are okay with it. Options here can be of two types, right? What is that? Buy option and sell option. By the way, they have a different terminology over here. for options. And what is that? When you
Call
say
and
buy option, it is call option. Am I right? Option to sell is called as put option. Same two concepts, that is buy and sell. However, terminology is slightly different. For options, it is called as call or put. Right? All right. Now, what are the parties involved and what is basically the process? So, say for example, I have let's say dollar with me. Okay. So I have say $100 with me, and I want to sell this. Right? I want to sell this. The prevailing rate is, let's say, 58 rupees. It is rupees 58 per dollar. Rupees 58 is the prevailing spot rate. I have $100. So I am writing, I am owner of this $100. I am writing a option, which means I am known as writer. I am known as writer or grantor, right? The person who is essentially going to sell the call, right? So I am the one who is the writer or grantor. I may be buying or selling. Here in this case, I am going to essentially sell a particular option. Which option am I going to sell? Should I say I want to buy 100 or should I say I want to sell 100? Both the options are available or only one option is available. Which one can I sell? So I want somebody to buy this $100 from me, right? In future. So I'm going to sell a call option. So I'm writing an option, which is call option, because I already have this $100. Somebody can come to me and buy this call option. Now, what are the requirements? So say, for example, there is Miss Mamta over here. So I'm telling Miss Mamta, I will sell you this $100 30 days from now. Okay. 30 days from now at 59 rupees. And you have to, for this particular option, to buy it at 59 rupees, you need to pay me, let's say, for example, rupees 5 as premium. Now try and understand. One is, I am going to have this particular option of you buying. So if I were to offer $100 to you 30 days down the line, right, where you have a obligation to perform, that becomes a futures contract, right? That essentially becomes a futures contract. But here I am giving you an option. There is an embedded option in it over here. And that option is that you may essentially buy or you may not buy. It is your choice. Now, when I'm giving you that choice has to have a consideration being paid, right? I will not do something for free for you. So, for me to write this particular contract, every contract needs to have a consideration for it to be a binding contract, right? So, if I'm going to give you this particular contract, wherein, say, for example, tomorrow you are not going to exercise this option, then entire activity was a futile activity for me, right? There has to be consideration. So that premium is the consideration for this call option or put option, right? Now, say, for example, 30 days from now, the market rate is, let's say, for example, the market rate is, say, rupees 60. Market rate is rupees 60. Market rate is rupees 60. So will Miss Mamta exercise this option?
yes,
Yes?
Yes, she can buy at 59 instead of buying it from the market at 60.
Very good. So here in the process, how much money will Miss Mamta make on this, in this particular contract? Yes?
1 rupee gain.
How much money will she make? Remember, it's $100, right? So 100 into, she is going to buy from me at 59. She will sell it in the market at 60, right? So this 1 rupee becomes her profit or saving, you can say. Yes, everyone? So she is making 100 rupees as a profit. However, for earning this 100 rupees, she had paid me a premium of 5.
Five.
Her net profit is 95 rupees. Are you all with me?
Yes, sir.
Right? What about me? Have I made any money on this? Have I made any money on this?
Premium,
profit,
sir.
profit to one is
Premium.
loss to another. That loss will get net with the premium receipt of inflow.
Yes. So here I have made an opportunity loss over here, right? I could have sold this in the spot market at 60, but instead of 60, I am selling it at 59 because of this obligation. So I have a opportunity loss of 100 rupees, right? And I made a profit of rupees 5. So my loss will be opportunity loss of 100 minus 5. So I would have made 95 rupees as opportunity loss. Are you all with me?
Yes, sir.
Right? Now, the same concept is applicable where you are either writing a call option or you are saying you are providing a put option. So let me take now an example of put option, for example. So let's take a put option example. So now I am selling a put option. Now what is a put option? Put option is right to sell, right? Put is basically right to sell. So now I am selling this option to Miss Mamta and I am telling her that you can essentially sell US dollar 100 to me, right? Prevailing rate, spot rate currently, let's say, spot rate today is 50, let's say 50, 58, okay? And I'm telling Miss Mamta that I will buy $100 from you, right? At rupees 59. At rupees 59. 30 days is the period. 30 days from now, let's say. 30 days from now. Okay. Premium is, say, for example, for this contract is rupees 5. Now, Ms. Mamta decides to exercise this offer made and she accepts the offer. So, she has paid 5 rupees to me, right? So, I am the, what is the name of my, what am I known as? I am known as writer or grantor, right? And Ms. Mamta is known as
Holder of option.
option buyer or option holder, right? Okay. Now she has paid 5 rupees. Now, what if the market rate is rupees 60? The spot rate in the market is rupees 60. Will Ms. Mamta exercise this put option?
No, sir. In case
a
of
right
put
to sell.
option, in
Yes,
case of put option, if the prices go down, then the option holder will exercise that put option.
very good. So it's basically, in case of call option, you are basically securing yourself against the rise in prices. In case of put option, you are protecting that is, the buyer is protecting himself or herself against drop in prices, right? And that is why we say it is a hedging product where it allows you to limit your losses, right? So if it is rupees 60, then she will not exercise the option, right? She will sell it in the market. So she is not going to exercise the option. So she is going to sell it in the market. 100 into 60 minus 59. This is the profit she will make in the open market. This is open market, she will make 100. And what is the loss she has already made on this particular contract?
₹5 premium she paid.
5 rupees premium which she had paid. So she will now have 95 rupees profit. Say for example, if this price had become rupees 55, then what would have happened? Would she exercise the option?
Yes.
Yes. In that case, how much profit will she make? 100 into
4.
it will be, yes,
59 minus 55, that is 4.
59 minus 55, right? Because prevailing spot rate, this is the spot rate. In spot rate, you are having 55, while the option price, the strike price as they call it, right, or exercise price is 59. So she will be able to buy it at this price, thereby making 400 rupees as profit. And for this, she had paid how much? 5
Same.
rupees. So she makes a net profit of 395. Are you all with me? Is that clear to all of us? Okay. I believe these are very basics. Most of you might already be aware, but I just wanted to be sure that we have the concepts in place before we go to the first question. Right? Now let's start with the first question. So we have question number 1 in your assignment sheet 2. You have question number 1. So we will take up that particular question. I'm going to copy paste that question over here for your easy reference. All right. Is this question visible?
Yes, sir.
Yeah. Okay. Let's start. What is this question asking us to do? XYZ Limited, an Indian firm, will need to pay Japanese yen 500,000 on 30th June. On 30th June. Right? In order to hedge the risk involved in foreign currency transaction, the firm is considering two alternative methods: forward market cover and currency option contract. On 1st April, following quotations are made available. On 1st April, so this is a spot rate and you have a 3-month forward rate. Spot rate is 1.9516, 9711, and 3 months forward is 1.9726 and 1.9923. What is the currency over here? Japanese yen to
Is it
INR.
INR?
Okay. All right. And what is the currency that you actually want to buy?
Yen.
Is yen.
You want to buy yen. So in that case, will this be the perfect rates, or will you need to change this?
Change it, sir. We need to express it in rupees.
So these are already here. The base currency is INR, right? So this is Japanese yen per INR. We will need to essentially do the indirect quote of this, right? Because we want to essentially deal in Japanese yen.
Sorry. Yeah, I meant yen. Yes, sir.
So the prices for forex currency option on purchase are as follows. So you have strike price 2.125, call option June, put option June. Now, when this is being mentioned, this is nothing but this is the way you are mentioning the call and put premium, right? Because options, as we just now saw, you need to pay premium for that, right? It's not free. Now, Japanese yen 0.047, it means it is, you need to pay this as a premium to get the call option or put option respectively. For excess of balance of JY covered, firm would use forward rate as future spot rate, right? You are required to recommend cheaper hedging alternative for XYZ Limited. Okay, so I have 500,000 Japanese yen which I will need to pay on 30th June. So I need to have forward market cover. Forward market cover is a simple option. You already have the rate available. You just find that out and then you will have the amount of outflow available. Then in currency option, we will compute how much is the total outflow, and then between the two, we will try to identify which one has a lesser outflow and we will opt for that one. Right? Let us start. All right. So first and foremost, my option one. Option one is forward cover. Yes. So how much will be my 3-month forward rate for me? Can you help me? What will be my 3-month forward rate? I have to
Reverse.
convert this JY upon its JPY upon INR, right? I will need to have a reverse quote. Am I right? I will need to reverse this. Do you all agree with me? Because these are the rates which are mentioned as Japanese yen to INR. What I want is essentially I want to buy Japanese yen, right? So I want to have Japanese yen in the denominator as a base currency.
1 divided by 1.9923.
Okay, so I want to buy 3 months later. So I would say, yes, you are right. You are 1.9923. But in that case, what is the currency you are going to buy? This 1.9923, what is the currency you are going to buy?
Yen.
No. What is the base currency? Japanese yen. This is Japanese yen. 1.9923 is Japanese
Oh.
yen.
Yes.
What is the base currency? Can you see
Base
the
currency.
denominator over here?
INR.
INR. So do you want to buy INR?
No,
Yes,
buy
sir.
Japanese current yen.
Yes.
Buy
I will
Japanese yen.
You want to buy Japanese yen, right?
by selling rupee.
Yes. By selling rupees. Exactly. So if you are going to sell rupees, then it is going to be which rate?
1.9726.
But this is a direct quote, right? So first of all, here, wait a moment. Here, first and foremost, now this is Japanese yen to INR, where INR is my base currency, right? So I have 1.9726 slash 1.9923. Now what I want is, I want INR upon Japanese yen, right? So can you tell me what will be my bid rate and ask rate over here? How do we convert direct quote, two-way quote, direct into indirect? Or indirect into direct? How do you convert that?
Bid will be 1 divided by 1.9923 and ask will be 1 divided by 1.9726.
Very good. So first of
1
all, it
upon
will be the reciprocal and bid will become the ask and ask will become the bid,
bid.
right? So this will be 1 upon 1.9923, comma, 1 upon 1.9726. Are you with me? Right? Now this is Japanese yen is now the base currency. Okay. So if I want to now buy Japanese yen, I will do it at this rate. Are you all with me?
Yes, sir.
Okay. Got it? All right. So what is going to be my 3-month forward rate over here? So my 3-month forward rate over here, I'm going to add more clarity over here. I want INR upon JPY. That too, I want ask rate. Am I right? Okay. So what will that be? That will be 1 upon 1.19726. What have I done? I think I've made a wrong number. Yeah, okay. So it is 0.5069451. Now that I have got this rate, I need to calculate. So now, how much INR will be required to buy Japanese yen? 500,000. I will say it will be 500,000. Should I multiply or should I divide? Should I multiply or should I divide?
Divide. No, multiply, sorry.
Multiply.
Please pay attention. If you can see on the screen, this is INR upon JPY, right? Now I want to convert this into INR. So am I going up the ladder or down the ladder?
Up the ladder.
Up the ladder. Up the ladder, multiply. Down the ladder, divide. I'm converting up the ladder. So it has to be multiply. 0.5069. Okay, I'll take 4 digits. So I get I'm getting 253,450. Are you all with me? 253,450. This is my total outflow in forward contract. Now I want to calculate my outflow as per options, currency option. So here I will say currency option. Yeah. All right. Now I want to buy Japanese yen 500,000. So should I be buying a option over here? Now the prices for forex currency option on purchase are as follows. Strike price is Japanese yen 2.125. Call option, put option is given to you, right? Now it is Japanese yen 2.125. That is my strike price. So basically underlying currency is INR or Japanese yen. Can you please tell me that? This currency option is expressed in Japanese yen or INR?
Japanese yen.
Japanese yen. So in order to purchase Japanese yen 500,000, how much money will be required by you? First of all, how much money will be required? Yes, outflow will be required will be how much? $500,000 should be multiplied or divided?
Divide.
Divide by what?
Divide 2.125.
Which is the strike price, also known as exercise price, right? 2.125. So I will need 235, 294.12. This is only for the currency price, right? Because that is the exercise price. Now I need to, of course, pay even the premium, right? how much premium do I need to pay, and whether it is going to be a put option or a call option. Which option am I going to essentially have?
Call option.
Call option? Yes? Is it call option or put option?
तो कॉल ऑप्शन, प्राइस बढ़ेगी तो वो उसी रेट पे ले लेगा और गिरेगी तो कोई दिक्कत नहीं है.
Okay. Now there is only one challenge. What is the underlying currency over here?
सर मुझे
Okay.
जापानीज येन चाहिए, मीन्स आई वुड सर्च फॉर ऑप्शन दैट समवन वुड सेल मी जापानीज येन.
अच्छा एक बात, let me ask you a simple question. Which is the pricing currency over here? Which is the pricing currency over here?
जापानीज येन.
जापानीज येन.
If the strike price is mentioned as Japanese yen 2.125, let me write over here. Just a moment. Okay. Now, this currency is mentioned over here as Japanese yen 2.125 for what? For INR. Am I right?
Yes,
Yes,
sir.
sir.
Now, what is your base currency?
INR.
INR. Do you want to buy INR or sell INR?
Sell INR, sir.
INR.
Buy Japanese yen. Am I right? You want to
Yes.
buy Japanese yen. That means you want to sell INR. This contract has a INR as the base price. So you should be buying or selling.
So selling.
Iron. Selling
Right? So
iron.
INR is the currency in which you are taking the basic position. So I will say sell INR, which would indirectly mean I am going to buy JPY. So I need which option? Call option or put option?
Put
Put
option.
option.
Put option. So my premium over here has to be computed as per put option,
option.
right? Yes? All right. So let me do the calculation over here. So in premium, this will be premium on put option. If you want, you can make some notes for yourself, okay? Like I have made over here. This is basically Japanese yen upon INR, so that you don't forget. As long as your concept will be clear, you will not have a challenge over here. Okay? So I have over here equal to 235,294, that is the Indian price which I am going to pay, and then I am going to calculate over here 0.098, because 0.098 Japanese yen is what you pay per rupee, right? So I will get what? I will get answer in Japanese yen. So I will need to use this exchange rate also over here. So I need to exchange at which rate? At which rate? In today's time, I will have to pay the premium today, right? So first of all, are you all with me? Premium has to be paid today, not 3 months later. So I will need to essentially convert this premium at the spot rates. Now spot rate में कौन सा वाला? Do I go for buy or do I go for sell? Yes. Which one?
Buy, sir, because I don't have Japanese yen, but I'll have to pay in Japanese yen, so I have to buy.
See, your premium on put option is, it is INR into 0.098. So what you have is Japanese yen available with you. So you need to sell this Japanese yen, right? Your obligation is, hello,
Yes, sir.
I have a put option over here. So I will need to essentially pay the premium, right? But premium has to be in which currency? So I have already got the INR equivalent, which I will require. Per INR, I am going to pay Japanese yen premium of 0.098. So the answer right now, as it is appearing as of now, is in Japanese yen. So if I want to convert this into INR, I will need to use which option? Should I be selling Japanese yen or should I be buying Japanese yen? I will
Buying Japanese yen.
essentially
Buying Japanese yen.
No, I will need to sell it, no? I already have Japanese yen, right? My obligation, I already have Japanese yen. The premium is there with me. I will sell Japanese yen so that I get INR, which I will need to settle it. Are you with me? Let me repeat once again. Why it will be 9516 and not 9711? I need to pay the premium of 0.098 Japanese yen per Indian rupee. Am I right?
Yes, sir.
Yes, sir.
So I will need to convert this at which rate? At 1.9516. Why is that so? Why is that so? Because I have Japanese yen which I need to sell. Am I right? Or in other words, INR is what I am converting it into. So I am buying INR, selling Japanese yen. Are you with me?
Can you re-explain this concept? Why I have to sell Japanese yen for paying premium?
Sir,
Yes.
sir, do one thing. Sir,
Okay, let me put it this way. Let me, 1 minute, just 1 minute, dear. Let me put it this way, so that it is easy for everybody. Hello. Because this is an important concept. So, wait a moment. Okay. Wait a moment. Okay. Now, first and foremost, we did this for forward rates. Can we do the same for spot rate as well? Then probably your concept will be a lot easily understood, right? INR upon JPY. Okay. So what is the spot rate? Can you please help me out? What is my spot rate given?
1.9516.
9516 and
Rupees per JPY.
1.9711.
11. So what will be my ask will become bid? Am I right? So it will become
Yes, sir.
1.19711 and then your ask will be 1 upon 1.9516. Am I right?
Yes, sir.
Now your obligation over here was mentioned. Premium on put option is in Japanese yen. Are you with me?
Yes, sir.
Now the
Yes,
base
sir.
currency is Japanese yen. So you said you wanted to buy Japanese yen. Am I right?
Yes, sir.
So now I will buy at this rate, which is the ask rate. Are you with me?
Yes, sir.
Okay. Now, am I going up the ladder or down the ladder?
Down the ladder.
No, I am going to convert this JPY to INR, right? All my calculations are done in INR, na? This
Up
is
the
rupee, na, my dear.
Up the ladder.
So I am going to go up the ladder. Up the ladder, multiply. Am I
Yes, sir.
right? Hello,
Yes, sir.
right? So here now I will have 235 924.12 into I am going to be selling as such put option, so 0.098 into 1 divided by 1.9516.
Sir, okay, got it.
Is that clear to everyone now? Yes?
No, sir.
Nahi?
No, sir. Sorry.
Okay. Once again, we repeat once again. So my rates are given to me, Japanese yen to INR, spot rates. These are spot rates. Are you all clear with that?
Yes, sir.
Is the conversion understood? How we converted these rates, which was Japanese yen to INR, into INR upon Japanese yen. Is that understood by all?
Yes, sir.
Okay. Now, when you are talking about premium on put option over here, premium on put option, you are told the premium which you have to essentially pay is 0.098 per rupee. So when you multiply these two numbers, 235 into 0.098, you are talking about Japanese yen. Am I right? So you need this much Japanese yen.
Yes,
Beyond
sir.
the premium. Yes,
Yes, sir.
I am the buyer, na? I am the buyer. So I need to pay the premium, right? So how much premium I am paying? I am paying in Japanese yen. So what is the rate of the Japanese yen? This is your bid rate. This is your ask rate. Are you going to sell Japanese yen or buy Japanese yen?
Buy Japanese yen.
Buy Japanese yen. So I need to have the ask rate.
Yes, sir.
I will buy at this rate, right? Ask rate 1.1 upon 1.9516. Right?
Okay, sir.
And since I am going up the ladder, right? I am converting Japanese yen into INR. So that is going to be multiply. So I say 235,924 into the premium amount which is there on put option into 1 upon 1.9516. Are you with me now?
Yes, sir.
Yes.
All right. Now, so what is the total outflow which we have? What is the total outflow that we have now on $235 plus 11,846. So my total outflow is 247 141. Now there might be, now in examination, remember, we are taking over here 2 decimal points, right? So I get 11,846 into 11,846.9788. So my total amount comes to 247. This is my total outflow. Total outflow.
Currency,
Which one is a better option?
currency option, second one.
So option 2 is better as it saves money for the, what is the name of the company? XYZ Limited. You want to find how much it will save, then we can always do that as well. That is 253 minus 247, 6308.90. Is that okay with everyone? Got it? All right. Now let us take question number 2 in the assignment 2. Let us take one more question. Let us take one more question. Let us build on what we have already done, because then it will be very helpful for you to recall, right? So we go to question number 2. Question number 2. Question number 2 in your assignment 2, right, which was shared yesterday with all. You may look at the question. If you don't immediately have it, you can look at it on the screen. All right. ABC Technologies is expecting to receive a sum of $400,000 after 3 months. The company decided to go for future contract to hedge against the risk. The standard size of future contract available in the market is $1,000. As on date, spot and future dollar contract are quoting at rupee 44 and rupee 45 respectively. Suppose after 3 months, the company closes out its position, futures are quoting at 44.50 and spot rate is also quoting at rupees 44.50. You are required to calculate effective realization for the company while selling the receivable. Also calculate how company has been benefited by using the future option. Okay, so first and foremost, I am expecting to receive, right? So I am expecting to receive a sum of US dollar 4 months, 400,000 after 3 months. So to start with, I want to buy or sell in the futures market.
Sell.
I want to sell, right? Sell US dollar 400K in the future market. Okay. So today when I sell the futures, I will sell it at what price? I will sell the futures at what price? As on date, spot and futures are quoting at 44 and 45 respectively. So I am going to be selling it at rupees 45. Are you all with me?
Yes, sir.
Now suppose after 3 months, company closes out its position, futures are quoting at rupees 44.50 and spot rate is also quoting at rupees 44.50. Fair enough. So after 3 months, the prevailing rate is at rupees 44.50, right? The prevailing rate is 44.50. So are you going to make money or are you going to lose money? This is the future which I have already sold, right? So I am supposed to receive my consideration at 45 rupees. Now the prevailing price has come down.
So
3 months
make
down the line. After 3 months, what has happened? After 3 months, the price has come down. I will receive how much? At 45 or 44.50?
45 का अगर फ्यूचर एंटर किया है तो 45 ही मिलेगा.
I will get 45, right? Because I have already entered into future contract. So I will receive at 45.
Sir,
The prevailing,
sir, why it is 45?
yes, so you will receive 45, right? After 3 months when the contract matures. Now the prevailing price is at 44.50. So this means by entering into this contract, you have made a profit of 50 paise per dollar. Are you with me?
Yes, sir.
So if I multiply that 400K, that is $400,000, how much money have I made? 200K rupees. Are you with me?
Yes,
Yes,
sir.
sir.
So this is my profit. Suppose after 3 months, you had asked over here, suppose after 3 months, company closes out its position with futures quoting at 44.50, spot rate at 44.50, you are required to calculate effective realization for the company while selling the realizable. Okay. So effective realization, meaning total realization. What will be the total realization?
45 into 44 lakh.
So total realization will be what? Let's say total realization. Now remember, in case of futures, there is no actual delivery, right? You're basically dealing in differences. So how much will I earn from the futures? From futures, I will receive 200K. Am I right? And then I will sell my currency, sell dollars in spot market. So how much will that be? 400K into rupees 44.50. So that will be, how much will that be?
17 lakh 80,000. Nice.
How much will that be?
One crore 78 lakh.
1 crore 78 lakhs, right? So I'm talking about, this is 2 lakhs.
17,800K.
So I have 1 crore 80 lakhs. 1 crore 80 lakhs. This will be my total realization. So in other words, what is the rate I realized? If you divide this by 400K, logically you should receive 45 rupees. Are you getting 45 rupees? Check.
Yes, sir.
Got it, everyone? Now, can you present this particular aspect, the calculation that we have done by yourself? How will you express
Yes,
it?
sir.
Total
Yes,
realization. So on futures, how much you will realize? You will realize 45 minus 44.50 into 400K. So you'll have 200K. And then by selling dollar in spot market, you will recover 400K into 44.50. So 1 crore 78 lakh. Total realization is 1 crore 80 lakhs. And when you divide by 400K, you are getting basically rupees 45, which was what was being agreed by you in the futures contract. Okay, is that clear with everyone?
Yes, sir.
All right. Now, let's take a break before we go to the question number 3. And then we will start with the third question where we will be comparing the forward contract and option. That is currency option, right? So, shall we take a break, please? Right. Now we start with next question, question number 3. In this question again, we are going to evaluate the options. I have taken this particular question from the Word into Excel file, so slightly you will find that my codes have come in like this. So what I have done is I have put the same table over here. We already have the question in assignment 2, but this entire data over here, like strike price, calls, puts, that is basically in tabular form over here, right? So I've added that also over here as well. But when I was adding over here, it got slightly jumbled up. Okay. All right. Let us read the question. An American firm is under an obligation to pay interest of Canadian dollar. This is 10 lakh 10,000 and this is 7 lakh 5,000, right? On 31st July and 30th September respectively. The firm is risk averse and its policy is to hedge the risks involved in all foreign currency transactions. The finance manager of the firm is thinking of hedging the risk considering two methods, that is fixed forward or option contracts. It is now June 30. Following quotations regarding rates of exchanges, US dollar per Canadian dollar from the firm's bank were obtained. So what are those rates? I have spot rate, so what we are given over here is the spot rate. What I have done is I have got this into a table over here, right? So spot rate is 0.9284, 0.9288, 1 month forward is 0.9501 and 3 months forward is 0.9556. Price for a Canadian dollar option on a US stock exchange. Cents per Canadian dollar payable on purchase of the option. Contract size Canadian dollar 50,000 are as follows. So you can look at this particular table now over here. The strike price is 93 cents, 94 cents, 95 cents, and these are basically nothing but the premiums which are mentioned for the calls and put option depending on whether you are going for July or September option, right? Remember, currently you are on June 30. So you are talking about 1 month over here and 3 months over here, right? All right. Now, according to the suggestion of finance manager, if options are to be used, 1 month option should be bought at a strike price of 94 cents. In other words, it is talking about this, right? So here this is 1 month for 94 cents, 3 month option at a strike price of 95 cents. So 3 month at 95 cents, and for the remainder uncovered by the options, the firm would bear the risk itself. For this, it would use forward rate as the best estimate of spot transaction costs are ignored. Recommend which of the two above methods would be appropriate for the American firm to hedge its foreign exchange risk on the two interest payments. All right. So first and foremost, you have an American firm. This is an American firm which has to pay in Canadian dollars, right? Now, all the exchange rates which are given to you as US dollar per Canadian dollar. So the base currency is Canadian dollar, pricing currency is US dollar. All right. So what are the two options available to me? Yes. What are the two options available to me? You can see over here, it's mentioned.
Forward and future options.
So I have fixed forward or option contracts. So if I go for fixed forward, which is the easiest of the lot, right? I just have to multiply with the currency that I need and multiply it with the forward rate or divide by the forward rate as the case may be. So I have an obligation of Canadian dollars, 10,10,000. I will convert that into forward contract. So if I do forward contract, I'll be doing it at what rate? 0.9501. Similarly, if it is a September obligation, I will do it at 0.9556. Are you with me? Yes?
Yes.
So, forward is the most easiest one to compute over here, right? Because it is very, very straightforward. Now comes the second part, which is options. So let us take the easier part, that is a low-lying fruit for us, so we can easily get those marks, right? Let us take that first. So here I will start calculating for forward cover. What is my, let me use the Excel numbers itself. All right. So option one is forward cover. So for USD required to pay interest in July. How much money you will require for this? I need how much? Canadian dollars. 0, 1, 0, 0, 0 into. Should I be saying into or divide?
Into.
Into. Why?
So the currency quote is given as dollar terms.
Remember,
Dollar.
this is USD upon Canadian dollars, right? USD upon Canadian dollars. So when you are going up the ladder, it is multiply. Am I right? 0.9501. So that comes to how much? It comes to 959,601. Everyone, are you all getting this number? I hope you are solving it along with me.
Yes, sir.
Right? All right. Now, tell me how much will be the USD required in September. September, how much Canadian dollars are required? I require Canadian dollars.
That's 5,000.
705,000.
Multiply by.
What is the
Point.
forward rate? Forward rate applicable 3-month forward is 0.9556. I get 673, 698. This is my option 1. This was the easiest of the lot, so we completed this very fast so that we can focus more time in examination on the one which is going to require more time and focus from us. Now I will start with option 2. Shall we start? For option, first and foremost, we need to understand over here that my contract size is limited to Canadian dollar 50,000 over here, right? Canadian dollar 50,000. So let me calculate the contracts required, right? So contracts required for July obligation. How many contracts will be required? Yes. How many contracts will be required?
Divided by that 50,000.
Divided by 50,000. Right. So that comes to 20.2. Can I have a decimal contract?
No.
So I'll obviously take 20 contracts, and it is mentioned in the question, right? What is being mentioned in the question? If options are to be used, 1 month option, 3 month option are bought, and for the remainder uncovered by the option, the firm would bear the risk itself, right? So it is clearly told to you that in that case, balance part, for the fraction parts, you don't need to take any cover. You are going to accept that much risk. Okay. All right. So I'm going to have 14 contracts for the September obligation. And for July obligation, I will have 20 contracts. Are you all with me? Yes. Now that is being established, now I need to do a calculation. So I'm going to, let's say, pick it up over here. Okay. Now let me do first for July, and then we will do for September. So here how we are going to go about is I am going to calculate for July. You guys will have to do it for September. Of course, I will do with a delay of 2 to 3 minutes so that you can even cross check if you are doing it right or not. Okay? Yes? So first and
Yes.
foremost, how much is the total cover available? So how much is the total cover available? How will you get that? I will say number of contracts multiplied by amount per contract, right? Amount per contract. So that comes to how much? The currencies also here. Canadian dollar and US dollar. So cover available is for 20 contracts into 50,000, right? Are you with me so far?
Yes, sir.
What is your requirement as far as dollars is concerned? How many dollars do you need? Yes. You need total how many dollars?
9,000.
We need total 10 lakh and 10,000, am I right?
Yes, sir.
10 lakh and 10,000. So I have got the cover of minus 10 lakh. So I get 10,000 which I will have to buy at spot rate. Okay. Now remember, I am an American firm. I need Canadian dollars 10 lakhs and 10,000 to pay my interest obligation in the month of July. I will need to convert this into dollar terms, right? My local currency. So what is the cost of this currency for me? Since I am booking a option over here, the option of 1 month is going to be priced at what? What is the value of the option for 1 month? Yes. What is the strike price? At what price I will be able to buy that?
0.94.
0.94, right? So I will be buying it at, this will be at this into 0.94, right? Are you with me?
Yes, sir.
Yes. At, because this will be bought by you at strike price, right? So 20 contracts into 50,000, you have got 10 lakhs from your options, from your future contracts. So you've got 10 lakhs. The balance 10,000, I will need to buy that at the spot rate. So this will be at what rate? Yes, let me write over here for your easy reference, 0.94, right? This was at 0.94. Yes. Now balance I need to buy at spot rate. So what is the spot rate given to us? We are informed over here. For this, it would use forward rate as the best estimate of spot. So what is the forward rate for 1 month?
0.9501.
0.9501. Right. So this will be at 0.9501. So 10,000 into 0.9501. So I'm going to pay 9,501 for the total value. Now this is the total value. Would you have any other cost for buying futures? Yes. Do you have to pay anything to buy these contracts? You want an option, right? Do I have to pay any premium? Yes.
Yes, sir.
To pay a premium for the contract. How much will that be? Yes. How much will that be? How many contracts are there?
20 contracts.
20 contracts. So I have 20 contracts with each contract being of $50,000. And what is the premium I have to pay? What is the premium I have to pay? Please pay attention over here. What is the premium that I have to pay?
1.02.
1.02. Is this 1.02? What is the currency over here mentioned? Let's read over here. It is cents per Canadian dollar, right? Cents per Canadian dollar. So it is 1 cent per Canadian dollar. Are you with me?
Yes, sir.
Which means 1 cent. So it is not a dollar. 0.1 cent. So 0, 1, 0, 2. Are you with me? Yes. Are you with me? समझ में आ रहा है तो is everyone able to follow? This I have to pay in dollar terms, right? That comes to 10,200. So what is the total cost for me now? 10,40,000. 9,40,000 plus 9,501 plus 10,200. So I get 959,701. Can you please try for the September part? Can you please try for September part? Has everyone got hang of this?
So we'll need that quotations for calculation, that table.
I'm sorry, dear, you are asking for something.
So that information regarding quotes I would need for calculation.
This one?
Yes, sir.
Okay. Take this again over here also if you want. Take it and put it over here as well for your easy reference. Right next to the table. I'm giving you guys a head start of 2 minutes. Okay. And then you can cross check whether your answers are going correct.
So my answer comes to 68,1258. Means 6,81,258.
All right, let's check now.
Sir, same here.
5,000 is
4778.
then I have over here
11480.
11,480. 480.
Is everyone getting this number? 681 to 58?
Yes, sir.
All right. Now, what am I supposed to do over here? I need to make a decision. Remember, you have an investor who is, or the firm who is a risk averse. You are told specifically the firm is risk averse, right? The firm is risk averse and its policy is to hedge the risk involved in foreign currency transaction. And now we are told recommend which of the above two methods would be appropriate to hedge its foreign exchange risk. So these are outflows. So for July, which one would you opt for? 959,601 or 959,601? 701 and 601. 100 rupees difference. So which one do we opt for July? Yes,
Forward cover. I think,
Forward,
sir.
sir.
forward. So this is the one which is the chosen option. What about 3-month cover? That is in September. 673 and 681.
Again forward.
Again forward, sir.
So again, forward takes a precedence. So we can write a recommendation over here to the firm. The firm should
Take a forward cover.
opt for forward cover for both the
Options. Month.
payments in June and September respectively, as it provides savings compared to options. Got it, everyone?
Yes, sir.
All right. So in this question, we did options. Now let us take one more question. Remember, our overall objective right now is to go from, we already computed for forwards earlier as well. That is what we started with. So we calculated forwards, then we started calculating for leading and lagging. We started calculating for money market hedge. Now we are calculating for options as well. You will have in examination, if it's a full-fledged question, you will have a question wherein they will essentially ask you to compute under all the 4 options or 5 options, and then you need to decide which one is the best option for the client, right? So our objective is also to reach to that particular point. We do individual each of them, and then we will take up a sum where we can essentially take them all together. So next question is about forward contract and money market hedge, right? So what we have done so far is in 1, 2, 3, what did we do? In first one, we had forward and currency option, right? In the second one, predominantly we had only option, right? It was basically an exercise in option only. In third one, we have done again forward and option. Now fourth one, we are doing forward and money market hedge. And then we will do a question on forward or money market hedge or option, all 3 in one same question, so that we can do the comparison, and that one question essentially becomes a good exercise in revising all 3 concepts for you. Okay?
So,
Yes, dear.
the question gives us information for the put options also, so we don't have to use that information to make analysis.
No, my dear, that is given basically to confuse you, right? Because you have to make the decision whether you want a call or you want a put. So underlying currency is Canadian dollar. So do you want Canadian dollar or do you want US dollar?
Canadian dollar.
Canadian dollar. So I want calls. Now you might say, why put? As I simply said, it is basically to confuse you, because you have to decide whether you want a call option or a put option, right? And majority of the students generally get confused, because here you can find over here US dollar is in the numerator. Majority of the times students are used to practicing with US dollar being the base currency. So whenever you have such questions, more often than not, because they are accustomed to it, they are not able to adjust and adapt, they essentially end up making a human error. It's not that they don't know the concept, they know concept thoroughly, they can actually calculate very well. However, it's only at that particular point, due to the examination scenario, maybe anxiety, pressure, or whatever, they sometimes it's just the muscle memory, right? That you essentially. Yes, dear.
सर, क्या ये लॉजिक काम कर सकता है कि अगर कोड्स डायरेक्ट हैं तो हमें कॉल और पुट जैसे लेना है उसका जस्ट रिवर्सल इनडायरेक्ट कोड्स में हो जाएगा?
If you are given in the direct, I mean, you have to convert first of all direct into indirect. The currency was reversed, right? That is what you are trying to say.
सर, लाइक डॉलर एंड रुपीस है सर, रुपीस में अगर हमें गिवन है तो इनडायरेक्ट कोड हो गया, और डायरेक्ट अगर डॉलर में ही हमें रुपी गिवन है, करेंसी रेफरेंस करेंसी डॉलर है, तो हमें डायरेक्ट कोड गिवन है। अगर डायरेक्ट कोड के कॉन्टेक्स्ट में हम पेमेंट और रिसीव्ड का सोचते हैं तो कॉल पुट हमें डिसाइड करने में इजी रहता है। बट जब अगर हम इनडायरेक्ट कोड में सोचते हैं तो हमारे से गलती वही होती है कि पुट लेना है कि कॉल लेना है, पुट लेना है कि कॉल लेना है। तो हम क्या वो जस्ट अपोजिट कर सकते हैं, कॉल का पुट और पुट का कॉल, बिकॉज कोड आर इनडायरेक्ट?
No, you can't do that. I will tell you the reason for that. See, when we are converting the two-way codes, yes, your ask will become bid and bid will become ask, and that to reciprocal. However, in calls and puts, when the premiums are given to you over here, you need to be very mindful that your underlying currency, your base currency over here is Canadian dollar, right? So you are expressing all the premiums, etc., in terms of US dollar cents, basically. These are cents, right? You can see in the question also it is mentioned, it is US dollar cent per Canadian dollar, right? So as a
Yes,
result
sir.
of that, if you are going to have the reverse, it is not necessary, it may be going at the same rate, because in that future market, probably you may have a different rate going on locally. So that is the reason we cannot essentially say that because it is US dollar to Canadian dollar this, so if it is the other way around, it necessarily has to be this only.
Okay, sir.
Are you with me?
Yes, sir.
Okay. All right. Now we go to question number 4. So let me again put the question 4 also over here before you. All right. Now is everyone able to see this question now?
Yes, sir.
Okay. All right. Okay. So here is a question on forward contract and money market hedge. Let's start. Columbus Surgicals Incorporation is based in US, has recently imported surgical raw materials from the UK and has been invoiced for pound 480,000 payable in 3 months. So you have been invoiced pound 480,000 payable in 3 months. It has also exported surgical goods to India and France. The Indian customer has been invoiced for pound 138,000 payable in 3 months, and French customer has been invoiced euro 590,000 payable in 4 months. Current spot and forward rates are as follows. So you have pound to USD given to you. Spot rate is 0.9830, 0.9850. 3-month forward is 0.9520, 0.9545. So you can see over here, first and foremost, the currency, that is the base currency, US dollar, is expected to depreciate, right? All right. US dollar to euro. Spot is 1.8890, 1.8920. 4 months forward is 1.9510, 1.9540. So here the base currency is expected to appreciate, right? All right. Now, next, current money market rates are as follows. So money market rates are as follows. So you have 10% to 12% per annum, 14%, 16% per annum, 11.5 to 13% per annum, which means this is your bid rate. If you want to borrow at, you are going to invest, then you will get this rate. If you want to borrow, then you will get at this rate, right? So if you are investing, you will get 10%. If you are borrowing from a UK bank, you will get at 12% per annum. You as treasury manager are required to show how the company can hedge its foreign exchange exposure using forward markets and money markets hedge, and suggest which hedging technique is the best. Okay, all right. Now, first and foremost, I have a American firm, right? So we are in US right now. So it's a firm in US. He has a obligation to pay. So it's supposed to pay how much? 480 pound. 480,000 pound in 3 months' time. Further, you are told you are going to receive some money. How much you are going to receive? Indian customer has been invoiced for pound 138. Pound 138 for 3 months. And then I am also going to receive euro 590,000 in 4 months. Okay. All right. And now you are told that you can hedge your risk by using forward markets and money markets. Fair enough. Forwards is generally the fairly very easy because it is straightforward. Now my question is, first and foremost, I should take cover for how much amount? For 480 or lesser or more?
So 480 minus 138.
Very good. Why?
Sir, इस net exposure हो जाएगा.
Exactly, right? You have to do the netting over here, or rather, the principle that we have learned is internal technique, right? You can match the two deadlines. These two are falling due on the same date. So I can essentially say this is received, this is payment. So I have a net exposure of 480 minus 138. So whatever is the amount coming as a result of that, right? Something like 342. So I will take a forward cover for 342,000 pound. 590 is after 4 months, and any which ways it is a different currency. All right. Very good. Okay. So now we are supposed to book this at which forward rate? What will the rate I will book at? Yes. What is the rate I should book at? Let us start option 1. Option 1. Forward cover. So first of all, I will take a cover for the obligation to pay. I will write over here GBP. GBP how much? 480,000 to receive how much?
GBP 138 lakhs.
138. These are both after 3 months, right?
Yes.
After 3 months. So I can take the same together. All right. So net obligation to pay is how much? 480 minus 138. So I get 342 as my net obligation. Are you all with me? So far so good. Fair enough. Now let's take the contract. So I will buy the 3 months forward. So buy 3 months. Should I buy or sell? Yes. Should I buy or sell? Buy 3 months forward cover for GBP. Am I right? I need GBP to pay, huh? Yes or no?
Yes, sir.
Yes, sir.
So how much should I essentially be paying?
Multiply by
Sir, I need to
0.95.
calculate in USD. Yeah? How much USD do I need to pay?
Multiply by 0.9545.
I'm sorry, Beta. Can you please be loud?
Multiply by 0.9545.
0.9545 पे.
0.9545.
At 0.9545? Okay. At 0.9545. What is your base currency?
Base currency is dollar and reference is pound.
Okay. So here I have been given over here the rates are pound upon USD. Am I right?
Yes, sir.
So 3 month forward is 0.9520, 0.9545. This is bid price. This is ask price. Am I right?
Yes, sir.
Okay. So when I want to convert my pounds into dollars, what do I do? First and foremost,
Down
which
the ladder.
do I need to buy or sell? Yes. What is the base currency over here?
So GBP is base given, no?
So should I first of all be converting this into reverse?
Yes, sir.
Yes, sir.
USD to pound, right? So now what will this become? My ask will become bid. So this will become 1 upon 0.9545, and here I will have 1 divided by 0.9520. Now this is base currency pound, right? So this is the price of pound. I want to buy pound. So I will have to buy pound at what rate? At ask,
0.95.
right?
9526.
So this is my rate, and I want to convert pound into USD. So should I multiply or divide? Yes, multiply or divide. Up the ladder, multiply. Down the ladder, divide. Down, divide. Up, multiply, right? So I am going to say over here, I need, okay. So I'm going to say equal to 3,42,000 into 1 divided by 0.9520. So I'll get 359, 243.70. Are you all with me? Now I cannot have in points, so I can always round it off. Equal to round off this 0, right? So it becomes 359, 244. In the examination, even if you write 0.70, it's okay. I'm rounding up to 244. Okay? Now, what is my second option? What is the second option I have? Option 2 is
Money markets.
okay. So how do I create a money market hedge? What will I need to do? Yes. Do you remember what did we do in the previous lecture on money market hedge? How do we create a money market hedge?
All options.
So first of all,
Borrowing in GBP.
yes, very good. So what am I going to do? I have an obligation to pay. So I want something which is going to result in an asset, right? At that particular point. I want a GBP asset coming over there. So how will GBP asset come over there? I will need to invest something today.
Yes.
Index dollar price.
Am I right? So if I want to invest in GBP today, let me put it over here. Wait a minute. So first of all, what do I need to do? I have an obligation. 3 months later, I have an obligation to pay, right? I have a liability. Are you with me? So I want a situation which will give me asset which I can use to pay off this. In order to have my asset over here, I need to invest something today. Am I right?
Yes, sir.
Invest this.
In
I need
GBP.
money. I don't have money, so I go and create a liability today. That is, I borrow money today.
Borrow
Right?
in USD.
My liability is in pound. Am I right? So I would need an asset in pound. So I would essentially need to invest something in pound,
Point.
and I will need to essentially borrow.
In USD.
Yes, I will borrow over here, right? Borrow today in
USD.
USD, which will be used to buy pound, right?
Yes,
I will
sir.
borrow USD to buy pound today. So that after 3 months, the maturity value will match. Okay. All right. Now the question arises, what is going to earn at what rate or where you have to pay at what rate? So when you are investing in pounds, you are going to earn interest in pounds,
10%.
right? So in pounds, you are going to earn how much interest?
10% into 3 by 12.
Into
3
3
by
by 12. Very good. Dear. Okay. All right. Now I have a liability over here in dollar terms. So on that, I will have to pay at what rate?
13% into 3 by 12.
USA, you can borrow at 13%, you can invest at 11.5. So I'll need to borrow at 13%. So it will be at 13% into 3 upon 12. Am I right?
Yes, sir.
Okay. Now, the interest rate part is sorted. I need to identify what is the amount I need to borrow. Right? So for that, I need to know what will be the rates at which it is going to get covered. Am I right? So,
Yes, sir.
how much amount, first of all, I will require? So here, I am going to require 342,000 pounds. Am I right?
Yes, sir.
342. So how much will be the present value? How will you find present value over here of this investment? This is the maturity value of the asset. My liability is of 342, right? So obviously I need an asset of 342 to set it off. So I am creating an investment today of what present value? 342 divided by 1 point. This is 10% into 3 upon 12. So it is 2.5%. Am I right?
Yes,
Yes,
sir.
sir.
So what is the amount going to come to? This amount will come to how much? 300 and
333. 650.
333. How much? 333.
333,000.
Sir, 333, 658.
333. Okay, 333, 658. Okay, so that is the present value.
राउंड ऑफ करके 659 कर दीजिए सर.
Okay, 659. We make it 659. Okay, so what my friend over here is suggesting, she's saying that we round it off to 9. The reason being, if we take those 20 cents also less, in future we will have 20, 25 cents less and it can create an issue, right? So she wants to err on the higher side so that at least you will have maybe a half a pound or 1 pound more rather than falling short. So completely fine. That is very good. Okay, all right. Now I have got 333, 659 pound to be bought by you. So I will buy this at what rate today? I will have to buy it at spot rate today. Yes. This 333 will need to be bought today at what rate?
Spot rate.
At spot rate, right? So what is the spot rate at which you are going to buy this?
सर स्पॉट रेट शो नहीं हो रही है स्लाइड
The spot rate? Yes. What is the spot rate? I think I have. This is the 3-month rate. What is the spot rate over here? Let me. What is the spot rate?
0.9830 or 0.9850.
30 to 0.9850. Right? So we are going to take which rate?
0.9850.
$9850. Your underlying currency is USD over here. The rate is base currency is USD. What are you going to buy?
Pound.
What are you going to buy?
Pound.
Pound. So you want to buy pound. That means USD is going to be
0.9850.
USD is going to be sold. Am I right? Yes or no?
So the rate is $1 per GBP, na sir?
what is being mentioned over here? Just 1 minute. It is pound per USD, isn't it? Hello? It is pound per GBP per dollar, am I right? You have written over
Yes,
here.
sir.
It
Yes,
is
sir.
GBP.
Per dollar.
Can you see it over here, my dear?
Yes, sir. Yes.
It is GBP per dollar, right? So I am going to buy dollar or sell dollar?
Hold. Sell dollar to buy GBP.
Buy GBP. So I need to convert this 333,659 at prevailing rate, right? So I need to have pounds being bought. So for pounds being bought, what will be the rate? The dollar rate will get reversed, am I right?
Yes, sir.
So bid will become ask. Are you with me, or do I need to write over here again? Hello, let me write it. Just. Or let me write it over here. So my spot rates are 0.9830 and 0.9850. So that means this will become 1 upon 0.9850 and 1 upon 0.9830. Now this is the ask rate, right? I want to buy pounds, so I buy at this particular rate. Am I right? So I want 333,659 pounds. So for that, how much do I pay? Am I going up the ladder or down the ladder? From pound, I am converting into USD. So I will multiply. So 333,659 into 1 upon 0.9830. Are you with me?
Yes, sir.
Okay. So I will get how much amount? It will be something higher than 333, right? Something like 339 or something. चलो यहाँ पे कल कर लेते हैं. Let's start. I think we all have got the hang of the concept at least. So I'm going to borrow today in USD, right? And use that money to buy GBP. Then at maturity, I just have to pay off my USD loan. My GBP investment is going to convert into the maturity value at 3 months later, and it will take care of the liability. That's the concept of money market hedge. Let's start. Okay. All right. So now, first and foremost, I have to essentially identify maturity value of obligation to pay is how much? 342 GBP. Am I right? GBP 342. All right. This is 3 months later. Okay, 3 months later. So if I want to invest in GBP 10% today. So what will be the value I have to invest today? That will be 342 divided by 1 plus 10% divided by 4. You all with me?
Yes, sir.
So I got 333, 658.5366, right? Now, as my friend over here, ma'am had said, let's round this off, right? So we will get our obligation as 333, 659. This is my investment, right? This is my investment today. This is investment in percent today. Okay. All right. Now, in order to get this money, I need a borrowing. Borrow in USD. At what rate? At 13%. Okay. All right. So, how much will be my borrowing? Yes. How much will be my borrowing? So, I will say it will be.
Spot rate of that GBP.
I need to have 333, 659. Right? At what rate? I will need to buy today this much at the spot rate, which is into 1 divided by 0.9830. Am I right? समझ में आया ये कहाँ से आया? Are you all getting it? Yes. From where did you get this? So from where did I get this number? It is from here. Remember, we converted the direct quote into indirect quote so that we can have USD per pound. And then the ask rate is 1 upon 0.9830 per pound. Right? So I have to borrow this much in USD. Now, after 3 months, I'll have to settle this loan, right? So, repayment in USD after 3 months will be how much? Yes, it will be 339,429.30 into, you will have to pay interest, right? 1 plus 13% divided by 4. Are you all with me? Yes, are you all with me? So my obligation comes to 350,460.75. So when it comes to repayment of this GBP, my total cost or total outflow is 350,460, and in case of forward cover, it is 359. So for GBP obligation, which option is better? Option 2 is better, as it saves USD. How much USD it saves? 359. 244 minus 350, 460, 155. So it saves 8,783.25. This is for your obligation. Okay. This is for your obligation part. This is the recommendation you are giving for the GBP obligation. But you also have one more aspect which you need to cover, right? The question is, has everyone got this? We still have second one to cover. What is the second thing remaining? We have one receivable, remember? The receivable is in from the French party. I have another 590,000 euro. You are told US Treasury Manager are required to show how the company can hedge its foreign exchange exposure using foreign markets and money markets hedge and suggest which is the best hedging technique. Okay, so when it came to GBP, we have already done that calculation and we find that money market hedge is better. Now, the second exposure which I have, euro, 590,000. So for that also you will need to do the same process. However, it would be the reverse part, right? Why do I say reverse part? Because here it was obligation to pay. And here it is going to be, we are going to have a receipt, right? We don't have an obligation to pay. We are going to receive money. So it's a reverse case, which we will be solving now. Shall we start? Has everyone got hang of this?
Yes, sir.
All right. Now, let's take care of the second obligation. C, B. Okay. Now here, I don't have obligation to pay. Let me change these things over here. Okay. All right. So first and foremost, forward cover, which is the easiest part. How do we go about doing that? Yes. Let's start. So forward cover. What do I have? After 3 months or after 4 months?
4 months, sir.
After 4 months. Be mindful. Here the examiner has been very, very smart and tactful because they know that majority of times students will focus only on GBP part and they will essentially forget the euro part, right? So you have to be having good presence of mind over here. All right. So I am going to be receiving, has been invoiced for euro 590,000 payable in 4 months. What are the rates for US dollar to euro? Spot rate is 1.8890. Remember, euro is the base currency over here. 4 months forward is also given to you, right? And current money market rates are as follows. So now we are going to talk about France and USA. Okay. So my money market hedge will involve rates of interest from France and USA. All right, fair enough. Let's start. First and foremost, I need to sell sell euros, right? I'm not going to buy. I have an obligation to pay. No, I have a receipt, anticipated receipt. After 4 months, so I'm going to have a receipt, right? So forward hedge is required for what value? For euro. How much was the value? 590.
90.
590,000. Okay. All right. So if I'm going to sell this is a receivable, remember? This is a receivable. So if I'm going to sell this cover, sell the sell the euro, right? I will receive euro. I will sell the euro. At what rate? If I fix the forwards, 4 month forward rate is what? USD per euro. 4 months forward. 1.9510 and 1.9540. So which one will you get?
1.9510.
1.9510.
1.9510. Yes.
10.
1.9510. So I will have 590,000 into 1.9510. Right? So that will convert to USD. This will be USD, right? This is USD. You converted this at 1.9510. It's 1.9510. So I will have 1151,090 if it is forward cover. Now I need to create a money market hedge. Sell the euro at forward. Okay. Yes. So now what is the second option? Money market hedge. So in money market hedge, I have now a receivable. I have a receivable. So what do I do in that case?
Borrow
Yes.
in euro, sir.
Let us look at it over here. So this is today. This is after 4 months, right? So after 4 months, I am going to have an asset. So what I need to do is I need to create a liability, right? The asset will be of how much? 590,000 euro, right? So I need to create a liability which is going to have a maturity value of the same amount, euro 590,000, right? In order to have the liability maturing, I need to obviously create a liability in terms of euro. Am I right? If I want an asset, I invest. If I want a liability, I borrow. Am I right? So I'm
Yes.
going to borrow. Borrow how much? Borrow how much? Will I borrow entire 590? I have to pay over here interest also, right? How much is the interest I will pay over here?
So can you scroll up for a bit, sir?
Yes. Now UK is no more in picture. So it is only France and USA.
16% borrowing rate.
So borrowing rate will be 16%. Yes. So borrowing here will be at 16%
For 4 months.
into 4 upon 12. Very good. Because majority of the students again make a human error by dividing it by 4 because they see 4 months, okay, divide by 4 because that is what they are used to. Right? All right. So 16% into 4 upon 12. So here, how much do I need to borrow? I will borrow 590,000 euro divided by 1 plus 16% divided by 3. Am I right? 4 by 12 is 3. Okay. So 1 plus 16% divided by 3. How much is this amount coming to? Yes, how much is this amount coming to? Okay. Now,
T 144.
I'm sorry. How
5
much?
lakhs. 5,60,144.
560, 144. Okay. So I am going to have 5,60,144 which I am going to borrow. Okay. All right. So if I am going to borrow this amount, take it over here in US, then I will have to invest over here, right? I'm going to invest over here in US. I will invest over here. How much I will invest? 561.44 at spot rate, right? So how much USD will be there? USD is equal to 560.144. What is the spot rate? Let me go back up. What is the spot rate over here? Which is the rate? It is US dollar to euro. Spot rate is 1.8890, 1.8920. Are you going to be selling euros or buying euros?
Buying euro.
I'm buying euro. I have already borrowed euro, right?
Sir, sell.
I'm going to sell euro. I have already borrowed euro, right? So the euro which I have borrowed over here, I will bring it over here and I will sell it. So I'm essentially going to sell this, and the rate is, sorry, what was the rate? 1.8890. Am I right? 1.8890. So should I be multiplying this or dividing this?
Multiplied.
Multiply, sir.
Remember, this is the rate of US to euro. So when you are going up, you multiply, right? Into 1.88. What is the 1.88 क्या था?
90.
1.8890. Whatever is this amount, should be more than 10 lakhs, right? I will invest this money and then I will earn interest on that. How much will be the interest I will earn? In US, we are earning 11 or 11.5%. In US, I am earning 11.5%.
5%.
Right? So I will earn over here, I will say this into 1 plus 11.5% divided by 3. You know why 3, right? Because it is for 4 months. So into 4 upon 12, that means divided by 3. Yes, what will be this number? So we will start now. Let's start now. Okay. Now, first, I'm going to start with this. Starting point is asset receivable after 4 months. That is in euro. How much euro? 590,000. Right? So we create a liability. Right? So I'm going to borrow. I'm going to borrow today euro present value. Get that. So it is 590,000 divided by 1 plus 16% by 3. So I get 560. I get 560,126. Is there some mistake which I have made? Let me take it this way. Oh, it is coming 560,126. 5,90,000. Ma'am, were you getting 560,144?
Sir, there may be some rounding of difference.
Okay. Rounding off.
There may be some rounding of difference because in Excel, I think it is more accurate.
Okay. All right.
Yeah.
So it is because of the rounding up, it is more accurate. Fair.
Because it is your 560, other figure is 144.
Okay. Fair enough. So this is more precise in answer. So there is no problem when you are doing with calculator. You may take with accordingly. Okay. All right. Now I have already got the borrowing in euros. So now what I'm going to do is I'm required to, I've borrowed in euro, I'm going to sell it in my local market today, right? So sell euro at spot rate today in the present time, right? So then I will get amount in USD. How much USD will I get? I will say 560,126 into 1.8890. So I'll get 10,58,079.114. Okay. Now this is the amount which I invest today. So what will be the maturity value? Maturity value of investment. This is in USD. Right? So I'm going to add 1058 into 1 plus 11.5% divided by 3 again. Remember why 3? Because it is for 4 months. Okay. It is after 4 months. This is maturity value of investment 4 months, after 4 months. So I get 1098,638 as my maturity value of investment. So if I sell forward, I will receive 1151,090, and if I sell it in money market hedge, then I will get a total receivable of 1098. So is money market option better? Yes. Which option is better? For euro receipt, which obligation?
Forward cover.
Yes, option 1 is better, right? Because it provides me, is better as it provides more USD, right? So how much more USD? You can always write it over here, 1151,090 minus 1098,638. So I get 52,000 more. Is this understood by all? Before we conclude for the day, let me recap what have we covered today. In the previous session, we had started with external techniques of hedging. Right? We had started with money market hedge, and we had also done one leading and lagging practical question. So today we started first of all with the concept of swap points, right? Then after completing that concept, swap points or forward points. And what is that? That is basically the difference we add. If the swap points are negative, then you will subtract from the spot to arrive at forward rate. Now, sometimes swap points are also given as numerator upon denominator, in which case you need to identify whether it is premium or discount, because sign will not be there. Then the only way to identify in that case is if numerator is lesser than denominator, it means it is positive. If denominator is lesser than numerator, right, then in that case it is discount. So we saw those examples also, right over here, 30-25. If it is 30/25, that means it is a discount. If it is 25/30, it means it is premium. We did the sum on leading and lagging with this swap point concept. Then we went to options and futures, right? In options, we have two types of options. Your buy option, which is known as call option, that is giving you, that is the call holder or the option holder, option buyer, has the option to buy, right? So remember, it is an option. So on maturity, he does not have an obligation to necessarily buy it. He has the option. It is the obligation only upon the seller to honor it whenever the option is exercised by the buyer. Opposite part is sell option, also known as put option. In that case, the buyer has the right to sell the asset at the predetermined exercise or strike price. Again, the writer has an obligation to honor by buying the asset, underlying asset or currency when the holder exercises the option. Right? In order to give you this option, the writer is essentially going to charge the buyer a small amount known as premium. Right? So, we looked at the concept of call and put option. Then we started with the questions on how to do the valuation, or rather evaluating the option. We are not doing valuation per se. We are doing only evaluating based on the information available from the markets. Right? So we are identifying which option is going to be better for my client or for my company. And we compared forward cover with currency option. Then we did question number 2, where we just evaluated the currency option. In question number 3, we again evaluated forward and cover. And now in the 4th question, we have done again forward with money market hedge. In the next question that we will solve tomorrow, we will do one question where we will have forward versus money market hedge versus option. And then there will also be 4th option which we will add is, say for example, there is no hedging, which means you are essentially going to cover your entire risk and convert it at spot rates, right? So we can see that, and then we will go to the swaps in the next session. Okay.
Okay. Is any student have any query? They can ask us. Otherwise, Amit sir, can you stop sharing your screen?
Yes, sir. Yes, sir.
Yes, sir. Dear students, thank you very much for patient listening, and we also thank you, Amit sir, for your an insightful discussion, because the points, that is what are we can say what are why when we have to add the premium points and when we have to consider negative points. Of course, you are saying right that if the numerator is lesser than our denominator, then it is a premium, and it is if the numerator is greater than denominator, it is a discount. However, sometime I'm just supplementing it. Maybe you have covered in your discussion. Generally, we said that if the points are in ascending order, like 25 by 35, so these are considered as an ascending order. So we say that these are is a premium points. Okay. Now, contrary to it, if it is mentioned, it is called descending order, and it is called are used as a discount swap points. So this is one point here. And one more thing, sir, since you have told that tomorrow class, student, please note that tomorrow there is no class. Class is scheduled as per, please check out the schedule. It is as per the schedule. I think it will be on coming Monday.
Yes.
And no schedules for the SFM class.
AFM, yeah, better. AFM, I think class is on Monday. Am I right?
But schedule is not updated
No
as
problem.
per.
No problem. But don't worry, because it is up to the November. Today we will host the schedule. Don't worry about the same. Okay, but please be sure it is on Monday. Tomorrow there is no class. Tomorrow I think their FR class will be there only. Okay. And next thing, sir, you have discussed with the option point, like when we talk about the option, of course you have explained very well, but I just would like to add some point. Sometime the crucial question comes in mind, which option we have to take, call option or put option. Student, when we have discussed the topic of derivatives, so as you know that call option gives a buying right of the underlying, whereas in put option, it gives a selling right to the buyer for underlying. So you have to visualize the situation, because if you have to need to buy any foreign currency, so of course you will go, because and foreign currency is basically an underlying, and you have to see whether it is a product selling, because sir has very rightly quote in what form we are quoting, which is a reference currency. So similarly we have to see that if the currency, suppose if we have been given the quotation for per dollar in Indian rupees, dollar is fixed, the varying currency is our Indian rupees. So it means our underlying is dollar. So in that case, we shall go for the call option because we need to buy the dollar. Because if we are an importer, on the contrary, if we are an exporter, so it means we have to sell dollars. So of course we shall take the put option. So this point needs a very important consideration. So it is very important to remember. And one more thing, when we talk about the money market hedge, sir has explained a very good example. But remember one thing, beta, money market hedge, why it is generally used, it is popularly used where any derivative instrument is not available. Because in that case, normally interest, and if you see, if you link it, it is generally linked to the interest rate parity because it is based on what interest rate prevailing in. So ultimately, sometimes even from the money market hedging, we can understand, we can reach near to the forward rate. It is one of the even method is used. So it has to remember, generally it is used, but if option is available both, so we can evaluate this option as well. And in the end, student, if you have any query relating to the same, so you can contact me at this telephone number. Okay. Or you can send us email at sfm-final@icai.in. So with this, we come to the close of this session. And Amit sir, thank you for your thank you for sparing your precious time and giving an insightful discussion for the students. And student, thank you once again. See you in the next class. Thank you. Have a nice day. I think सेशन ओवर है, लेकिन मैं लेट मी चेक, कोई क्वेरी आ रही है तो मैं देख लेता हूँ. ठीक है. कमेंट्स एक.
Can I leave, sir?
हाँ, okay sir, you can leave sir. Thank you sir. Thank you very much sir, Amit sir.
Thank you very much.
Okay, okay sir. हाँ नहीं, अभी है नहीं कोई खास. Okay, Ashok ji, you can end the session.